Hello, good afternoon, good evening, good morning to everyone. So, who is listening this lecture from whichever part of the world? So, today I'm going to discuss module number 5 for my unit at Australian Maritime College of International Trade. So, the name of the unit is Understanding Emerging Markets. So, emerging markets and understanding the emerging markets are very essential for the students, especially when they they will be employing in an organization which have the international trade, and they are exploring to enter into the new market. So that's why the understanding the emerging market is very crucial. By the way, this is Mujahid Chowdhury, Associate Lecturer of International Trade at Australian Maritime College, University of Tasmania, Australia. And I am also an Assistant Professor, Department of Port and Shipping Management. I'm on leave for study, so at Bangladesh Maritime University. So let's go. Firstly, we can focus on the focused question, what we are now going to uh, discuss or going to understand in this lecture today. So, our first concern is what makes emerging market attractive. Like which are which are the factors or the elements to understand the attractiveness of the emerging market, and then we also will look for the how to assess the true potential of emerging markets, and then we will be looking for what are the risks and challenges of emerging market for international trade and investment. So, before starting, let's have a clear discussion about the different types of markets or economies. Sorry, different type of economies. So, the first one is the advanced economies. In our lecture, we have discussed a couple of times about the advanced economies. So, what are the advanced economies? So, post-industrial countries with higher per capita income, and then competitive interest industries, developed commercial infrastructure. So the country which have the higher per capita income, competitive interest industries, and the developed commercial infrastructure, we can call them advanced economy. Normally, like the richest countries in the world, we consider like Australia, Canada, Japan, United States, and the Western European countries. They are considered as the advanced economies, Sweden, Denmark, Netherlands, Germany. There's a France. These are the Western European countries. So these are considered as the advanced economy. So the secondly, we are discussing about the economies which is developing economies. So like the low income countries, which is characterized by limited industrialization, and the economy is stagnant. That means the economy is not that much developing. For example, like Bangladesh, Bolivia, Zaire, and these countries are called the developing countries. And today we're discussing the most important part of the lecture, which is emerging market economies, because the business is experiencing an exponential growth in these economies. So it was mostly the former developing countries, and then it has achieved substantial industrialization over the time, modernization in their industrial system, banking system, transportation system, and the remarkable economic growth. Like, for example, Indonesia, Mexico, Poland, Turkey. These are some of the example countries for emerging market economies. So now let's have a look on the key dimensions and the differences in three types of economies. So the first one is, let's say, which countries are actually representing the advanced economies. Like I mentioned earlier, Canada, France, UK, and in the developing countries is Angola, Bolivia, Nigeria, and in the emerging countries, Brazil, China, India, India, Turkey. Okay, so a total number of approximately total number of advanced economies are 35. Okay, 35. But if you see the developing countries, they're too much, like too many. It is 125, and then the emerging market is only 30. So these are the emerging markets or emerging countries. Let's see the population. So you see, the advanced economies, they has the less population size. So this is sometimes not good for business, because to do the business you have to have the human, you have to have the people to whom you can sell the products, or like you can manufacture the product for them. So it's only 13%. On the other hand, developing economies, they are having 32%. But if you see the emerging markets, they have the huge base of the population. So per capita income is too high for the advanced economies. You see very low for the developing economies, like yearly, yeah, it's 3,700 US dollar. But in emerging market economies, their per capita income is actually increasing. So it is like now 13,800. So uh, you see the approximate world GDP. So they occupy 45% of the world GDP, and the developing economies are only occupying the 5%, and also the emerging market is occupying the 15% of the world GDP. So a few more dimensions. If you see the population in millions, so in advanced economy they have 100, 1100. They have 1100 million population. But if you see the developing economies, they have 2500 million economies. On the other hand, emerging economies, they have 4300 300 million. Telephone lines per 1000 people is a little bit higher. So the question may come, how telephone line can be a higher, like, or mobile phone can be higher for the people. So of course the many one person can occupy more than one. Okay, you see how much advanced economies people are using the fixed or mobile phone for their job and for their personal purposes. On the other hand, if you see, this is a little bit less. And in the emerging markets also, they have the good number of mobile phone user or the telephone user. Internet service provider, secured internet service provider for 1 million people. So you see, this is the huge gap. So for the spread of the business, you need to have the internet connection. If you see the advanced economy, they are super high, like the 1360. On the other hand, developing economies, for per 1 million people, only 15 internet service servers they have. Very few, very less. It is also very less in emerging markets. So if the internet connection get increased, so internet servers, so it will allow to expand the new horizon of the business. Internet users per 1000 people, it is more than 1000, because some people are using extra for their business and personal purposes. And then in the developing economies, 3,995, and in the emerging economies, in emerging market is 625. So motor vehicle per 1000 people, per 1000 people, 608 people has their personal motor vehicle. And on the other hand, per 100 people, only 62 people, they own the motor vehicle. So it is 252 motor vehicle is owning by the people of 1000 people in emerging market. Okay, so just to give you an idea, actually, how emerging markets are looking like. So you see, you see, this is actually the night scenario in the world. So you can easily assume, understand, like you see, the US is very much highlighted, even in the Europe, even in China, Even in India, India has a huge electricity. Okay, so here it is South Africa, here it is Brazil, and then here it is yes, it is the Arabs, Middle East, and then it is part of Australia, Brisbane, Sydney, Canberra, and then Melbourne, and then there's also New Zealand also. So in Malaysia, Indonesia, and then Indonesia, Malaysia, Singapore. So it is understandable that the emerging countries and the developed countries, they are actually having the higher electricity, and which allows them to have the more light. So it's a very impactful figure to see the differences of the developing issues, the development in the emerging, developing, and the advanced economies. So let's have a look more on the emerging market economies. So about 30 countries with rising economic aspirations that enjoy rapidly growing standards of living. So as I mentioned earlier, emerging economies or emerging market economies are almost 30 countries. So and they are now revolving, they are going forward to become a wealthy nation, to become wealthy nations. Okay, and they have a significant impact in the world economy because they are now becoming, attractive destinations for exports, for foreign direct investment, and for sourcing, like in terms of labor, well, skilled labor, in terms of land, in terms of resources sourcing. Okay, and some countries like Hong Kong, then Saudi Arabia, Singapore, South Korea, Taiwan, they have developed their market beyond the emerging market stage. So they are more than emerging market stage, because we understand like advanced economies, and then emerging economies, and then the developing economies. But some countries which are in between advanced and emerging, these are the like Hong Kong, Saudi Arabia, Singapore, South Korea, Taiwan. Okay, some other important issues to discuss, like what are the transition economies? So as I discussed just earlier, some countries which went beyond their developing beyond their emerging market conditions. So they used to be planned economies. Now they went to liberalized market. They're welcoming the investors, and they are like reducing the restrictions. So this is called the liberalized markets. So other are the privatization. So privatization, we all know about transferring the ownership of the state-owned or from the state-owned organ industries to private concerns. But another importantly called the new global challengers. So like the leading firms from emerging market that are fast becoming key contenders, like they are one of the key business organizations in their country. So these days some companies which are coming out from the emerging markets, and they become they are so fast that they become the key contenders, like they one of the competitors in the world. So these are called the new global challengers. So it used to be the companies from the from the advanced economies, but nowadays some companies from the emerging markets, they are also trying to penetrate the market in the world. So let's have a look on the trade condition in the major country group. So we'll be looking for based on these three dimensions. So advanced, developing, and emerging. So let's see the industry condition. In advanced economy, it is highly developed, but in developing countries, it's poor, and in emerging countries, it is rapidly improving. That means it is in the improving and in exponential improving growth they have in the industry. Competition, substantial competition, but they are very limited competition. On the other hand, in emerging market, this is also substantial. Uh, Advanced economies, they actually reduce the trade barriers, but still in developing economies, they have the moderate to high. Emerging countries, they have the moderate and to high. Trade volume, they have the high trade volume, and they have the trade volume, and also emerging markets, they have the high trade volume. So inward FDI, that means attracting FDI for their country. Advanced economy and emerging market, they are high or moderate to high, but in the developing economies, their inward FDI is very less because of their unstructured infrastructure, or like red tape, or different issues, not only one issues we can say. So because of this, they are attracting less foreign direct investors. If we see more other characteristics of these three economies, so we see average median age of citizen in the advanced economies is 39. So whenever you plan to organize any industry, any business in advanced economies, you must consider about the age group. But if you see in the developing countries, 24 years, also in the emerging market is 32 years. So this is the very important demographic feature for the businessman to get the idea to which section they should concentrate. Major sector focus. If we see the advanced economies, they become little bit laying down to the services like technology, like hospital industry, like service related industry, mostly like branded products. On the other hand, developing countries, they're still dependent on the agriculture and commodities. But if we see the emerging economies, they actually diversified their main focus to manufacturing and some other services. So it has been seen the advanced economies, they're mostly free economies in terms of their economic and political freedom, and in developing economies, they are mostly repressed. And in emerging economy, they have both. Like some of them are free, some of them are not free. Economic and political system, and mostly advanced economies are market economy. Developing economy, they are controlled or command economy, or sometimes this is mixed, but in emerging this is mixed. And because this economic and political system is very crucial, because they are actually controlling the total organizational setup of a country. So where to invest, or whom to invite for the investment, they are deciding. In advanced economy, they have minimum regulation. It's not that they are not having the law and legal aspect. Of course, they have, but for business, they are imposing legal regulations for the facilitation of the trade. On the other hand, developing economies are highly regulated, sometimes burdensome, and then for emerging countries, they are getting much economic liberalization over the time. So if we consider the country risk, very low risk, moderate to high risk in the developing economies, and like in emerging markets, it depends based on many factors. So intellectual property is very important, because let's say you are doing the you're doing the business of the pharmaceuticals industry. So for you need to have a strong intellectual property. So it has been found, if you do in the advanced economy, they are maintaining a strong intellectual property. But in the developing countries, very weak. In the emerging economies, between moderate and improving. So here I need to say one thing, that intellectual property maintenance is very crucial for welcoming the foreign direct investment, because when the companies are planning to come, then they will be looking for the countries which are actually protecting their rights. So one of the rights is intellectual property, which a business always should maintain. So that's what is very important. Now, if we go to the infrastructure, we'll see advanced economies are highly developed. Okay, and then and we see the developing economies are not that much developed, and emerging markets are in the moderate scale. So let's have a look how much over the time the countries have increased in terms of their GDP. So the estimated total increase in GDP and growth in GDP from 2020 to 2020. Five. It has been seen over the last 5 years. So China, they have tremendously growth in their GDP, like 51% almost, followed by USA. They have also increased their GDP, and then very interestingly, India, they have also increased some sort of like their GDP growth rate, and then UK. So countries are getting the higher GDP growth rate, meaning like they are trying to be like, getting much services they are getting. So now we know some emerging countries. We will be looking for the countries later, but let's have a look on the countries like Brazil, China, India, Mexico, Russia, and Turkey, and some of their key multinational firms, and what are the companies they are actually representing mainly. What are the main segments of their business? So if we see Brazil, so Brazil, highly agricultural based country, and then they are processing the food, and then they have the aerospace. Some aerospace companies, they are developing their aeroplane in Brazil, and they have the cosmetics also. So these the most companies are Brazil Foods, Embraer, and Natura Cosmetics. On the other hand, China, we know Alibaba Group's Huawei Technologies, Lenovo Group. So they are mostly in China. They are mostly dependent on e-commerce, information communication technology, and computer technology. In India, it's diversified because in India, Bharti Airtel is a telecommunication company. Infosys is a software or tech company, and Tata Motors is a motor company, like automobile companies. But this is a sister concern of Tata Group. So their main focus is the telecommunication service, technology consulting, and automotive. On the other hand, if we see the Mexico, America Mobile, Cimex, Grupo Bimbo, they are the main companies in Mexico, and their main focus is in these segments like telecommunication, building materials, baking, snacks. Russia mostly depend on the natural resources, so their main business is natural gas, oil, steel, and mining. So the companies like Gazprom, Lukoil, Sebastian, these are the very important companies for Russia. Likewise, Turkey, their main focus is on the industrial and financial confectionery. So now look at the emerging market firms of the global 2000. So Forbes magazine, you know about the Forbes magazine. Every year they publishes the list of world's 2000 largest firms. This is called the global Forbes Global 2000. And the number of companies from emerging market in the list now exceeds 600. So among 2000, 600 is from the emerging market. And over the times, many firms from advanced economies have fallen up from the Forbes list. For example, 33 Japanese companies or firms, they fell off the list between 2017 to 2022. On the other hand, the 89 Chinese companies were recorded in the list, meaning, like you see, the advanced economies, sometimes they're losing their money. On the other hand, the emerging countries like China, emerging market, they're grasping the market. And then Brazil, Indonesia, Poland, South Africa are among many emerging markets firms that have joined in the global 2000 list. So what does it indicate? It indicates how fast new global challengers are displacing traditional multinational enterprises from the advanced economies and becoming the key competitors in the world market. So this is very crucial message for all of us. So let's have a look on the China. In China's main value is his population. So it's 1.4 billion people. So like there is a proverb: if you throw a stone to the people, a group of people, there is a 40% chance they should be thrown onto the people of the citizen of China or India, because both of the country form the largest share of the world's population. But this population is sometimes blessings, because it helps to have the flourish of the business, because to fill up the gap and the demand of the huge population, you need to have the business. So China is also a big importer and pursuing market reforms in 1970s. So China in 1954 was an extreme communist, but over the time they actually revised their economic system, and as a result they got the explosive economic growth, like which is like quadrupling its GDP over last 30 years. And now China is becoming the second largest economy in the world, but still China is struggling to have the strongest infrastructure, which is very China is working on it, because they are like working on their infrastructure, transportation, logistics. China buys one third of the world's coal, cotton, fish, and rice, one quarter of the world's steel, and one half of its pork. So huge market to sell the sort of things in the Chinese market. But China endures serious problems of air, water, and land pollution, and has 10 polluted cities. So now come to the point, actually, what makes emerging market attractive. So let's have a look on this. The first one is like sometimes considering the target market. So uh, that's what emerging market, getting the thrive thrust. So one is the target market. Let's say, as we discussed, some countries which have the strongest buyer position. So, and many have huge middle classes with significant income from buying electronics, cars, healthcare services, and other countless other products. Many exhibit high economic growth rates. So this is one of the factor for attractiveness. The second one is about the manufacturing basis. So some countries they are having the very healthy environment for production, for assemble. So like China, Russia, South Africa. So these are having the some basis for producing them, because they have the low wage labor, high quality labor, skilled labor for manufacturing and assembling operation. And another is like the sourcing, as I mentioned earlier about the sourcing of the labor, land, capital, and then many things. So as for example, many international companies, they have the customer centers in India, in Philippines, to get it as cheaper price. Like Intel and Microsoft have much of their programming activities performed in India to get a good coder. So in India, they have the good number of coder, and like these investments from abroad benefits emerging market, which leads to job, technology transfer, and linkage to the global marketplace. So again, some concept you have to know about this. About one is outsourcing, which is the procurement of selected value chain activities, including production of intermediate goods or finished goods. So when we outsource, from the name we can know, from the goods or finished goods from the independent suppliers. Global sourcing, which is the like procurement from the different parts of the world. So this is important. Another point is called the purchasing power parity. So what is purchasing power parity? It's an economic theory which adjusts the rate among the country. It is an adjustment of the prices that reflect the number of goods that consumers can buy in their home country. So using their own country, consistent with their own standard of living. Purchasing power parity adjustment to per capita GDP, because relying on per capita GDP per comparison of different markets, it should not give the exact scenario. So one should, in that case, sorry, you use the purchasing power parity exchange rates rather than using the exact market rates, because this market rates the which are providing, it is not adjusted, or it is not giving the adjusted figure. So purchasing power parity adjustment provides a more realistic indicator for purchasing power of consumers in emerging and developing countries. So here is the differences in the per capita GDP normal, and then per capita GDP PPT adjusted figure. And then here we can see it is very easily understandable about the this purchasing power parity by an index developed by McDonald, which is called the Big. And not actually, this index has been developed by McDonald. This index has been developed by The Economist, the news magazine, which they developed this index based on the McDonald's burgers, which is called the Big Mac index. So uh, the index first gathers information about the price of hamburgers at McDonald's restaurant worldwide. So it then compares the prices based on the actual exchange rate to those based on the purchasing power parity price of Big Macs to assess whether a nation's currency is under or overvalued. So as for example, Big Mac index for the most recent year, we can see here, like you can see the countries, like the countries, they in the Europe, they have the overvalued index, like Sweden, Norway, Switzerland, Western European countries. On the other hand, those of the some emerging countries, market exchange rate has been, um, undervalued. For example, the index implies that the Chinese yuan and Indian rupee and Indian rupee are substantially undervalued. You see, these are the undervalued substantially compared to the dollar. So these Big Macs index assume that the business cost and McDonald's strategies are identical across countries. So let's say these assumptions may not be realistic. The index provides a useful information of purchasing power and currency evaluation around the world. So this is very important index to understand the purchasing power of the people of the country. So let's have a look on the top 10, top few emerging countries, top seven. So China, it's the data from 2013. Sorry, my mistakes. I couldn't come up with my actual latest data. So China has 15.5 trillion, India 3.2, Brazil 2.3, Russia 1.8, Mexico 1.3, Indonesia 1.2, 986.61 billion, billion um, GDP in terms of this. Let's have a look on the BRICS. You see BRICS in 1995, where Russia, China, and then India, and then South Korea. So it is seen they're having only, sorry, so they are having only 16.9%. On the other hand, developing, they used to have the almost 45%. On the other hand, in 2010, you see these countries, the BRIC countries, Brazil, India, Russia, China, South Korea, they got some momentum. And now in 2023, they're having the, very significant and substantial portion of the world's GDP. So it's very essential to see how emerging markets are rising. Okay, so let's see what are the key criteria for assessing the attractiveness in the emerging markets and the developing economy. So one of them is called the market size. How is the market size? How is the population? And then how is the market growth rate? Like the country's real GDP growth rate, market consumption capacity, like income of the middle class people, income of the lower class people, income of the high people, and like over that I discussed about the commercial infrastructure, like telephone lines, number of personal computers, availability of the internets, and then road connection and transportation and logistics connection. This is also important. And another important point is about the economic freedom. So if the company doesn't utilize the economic freedom, they will not be able to grow. So which also company looks for assessing the attractiveness of the emerging market. And the risk of the political and macroeconomic risk. Of course, we don't know the future of the political situation of a country, but overall, how is the democracy of the country? This is also important. So, what are the challenges of doing business in emerging market? Like one is political instability. Should be checked whether the countries are unstable or not. So weak intellectual property action protection. I told us earlier, for the research-based company, it's very difficult to enter into the emerging market because if they don't maintain the proper intellectual property rights, the companies will not enter. Like bureaucracy, red tape, lack of transparency. How much is in the advanced economy? So, how much is it in the developing countries? How much it is in the emerging economy or the underdeveloped countries? So, poor infrastructure. This has to be challenges for the emerging market. Rather, partner availability and qualification, resistance from the family conglomerate. So, some companies which are based on the family. So, these companies are all the time having the competition with the international competitor. So strategies for doing business in emerging markets. So firstly, it has to be conducted. They have to conduct research to understand target markets and the indigenous challenges, and then acquire new capabilities that build competitive advantage for them, for the company. And the company should customize offerings to unique emerging market needs. Partner with family conglomerates. This is also some strategies a firm can adopt. So market to government and in emerging markets, and leverage the same advantage in emerging markets enjoyed by local firms. So this is all about for today's lecture. I welcome you all, everybody, for participating in today's lecture and paying your attention.